Japanese yen. Yeah, that currency. You know, the one everybody pretends to understand because it sounds exotic enough to make them feel smart. But in reality, they're just parroting nonsense they heard on some recycled blog post from 2014. Huh, you really think you get it? Oh, the Japanese yen is a safe haven. Sure, genius. But do you even know why? Or is it just another thing you repeat at parties so other amateurs nod at you while sipping cheap coffee trying to look wise? Let's not waste time sugarcoating, because if you're listening to TRAXING, you didn't come here to get tucked into bed with a lullaby. This is about ripping the Band-Aid off, pouring salt on the wound, and finally seeing what the hell is going on under that rotting mindset of yours. We're diving deep into the Japanese yen, not with a cute little floaty, but with bricks strapped to our ankles. You ready? No? Too bad. So here's the raw truth. The Japanese yen isn't strong because Japan's economy is some golden temple of growth. Far from it. Japan has been in a state of economic molasses for decades. Decades. But still, this dusty, zero-interest, deflation-chasing relic of a currency is what the world flocks to when things go south. Why? Because the Japanese yen is one of the ultimate risk-off currencies. That means when your precious S&P 500 pukes 5% in a day and everyone loses their minds, investors go sprinting to the yen like it's grandma's basement during a zombie outbreak. Now here's where it gets juicy. Fundamentals. Yeah, you heard me. That boring word everyone avoids because it actually takes effort to understand. Not signals, not patterns that look like Batman wings on a chart. Fundamentals. You want to know why the Japanese yen behaves the way it does? Then stop worshiping your indicators like they're holy scripture and start thinking like a damn adult. First, let's assume you're not a total ignoramus. Let's assume you're aware of interest rates and monetary policy. The Bank of Japan? Yeah, that glorious gang of ultra-dovish economists who decided that zero just wasn't good enough. So they said, hey, how about negative rates? And the rest of the world gasped, while Japan just smiled and said, deal with it. This isn't a punchline. It's reality. The Bank of Japan has been pumping so much liquidity into the system through endless QE, it's like watching someone try to fill the Grand Canyon with a garden hose. And still, they get no inflation. It's almost adorable. But here's the trick. That ultra-loose policy means the Japanese yen becomes a funding currency. In other words, people borrow in yen because it's dirt cheap, and then invest in higher-yielding assets elsewhere. That's the carry trade, for those who skipped class. And when things go bad, when the markets turn red and investors get scared, they have to unwind those trades. They sell those risky assets and buy back the yen. Boom, yen strengthens. Not because Japan is some economic superpower, but because fear triggers a rush to repay those loans. Makes you think, doesn't it? But wait, you thought we were done? Please, now we talk about correlation. You little commodity lovers, pay attention. The Japanese yen has interesting relationships with commodities, especially oil. Japan imports nearly all of its energy. So when oil prices go up, it hurts Japan's trade balance. A weaker trade balance can pressure the yen. But, and this is where it gets spicy, when global oil prices crash, what usually causes that? Risk-off sentiment, which causes, you guessed it, the yen to strengthen. You see the irony? The same thing that hurts Japan's trade in theory, in practice, often boosts the yen in times of crisis because of the carry trade unwind. It's like watching a dog chase its own tail while screaming macroeconomics at the top of its lungs. Let's keep slapping your brain around for a second with this. The Japanese yen is a safe haven, right? That's what they all say. But what does that mean? Do you think it's because Japan is some utopia of financial responsibility? No. It's because Japan's capital account is massive, and during crises, Japanese investors repatriate funds. They pull money back into yen-denominated assets. Imagine all those old-school Japanese pension funds yanking their cash out of foreign markets the moment the wind changes direction. That's a tsunami of demand for the yen, and you're sitting there wondering why your USD JPY short just went up in flames. Don't blame your broker. Blame your ignorance. And for the cherry on top, let's talk about those traders out there acting like they timed the market using some magical Fibonacci dreamcatcher combo. Buddy, if you don't understand how monetary policy in Japan affects the global capital flows, you're basically gambling blindfolded in a hurricane while juggling knives. But I saw a trend line. Wow. Revolutionary. Did the trend line tell you about the Bank of Japan's yield curve control? Did it scream in your face when they decided to tweak bond buying operations last quarter and the yen flipped direction like a drunk gymnast? No? Then maybe, just maybe, it's time to shut up and learn something. And don't even get me started on those crypto geniuses trying to bring the Japanese yen into their nonsense. Oh yeah, because obviously Bitcoin's 10% daily mood swings totally reflect risk-off behavior. The only thing more delusional than that idea is your confidence level when you're 3 trades deep and your account is already limping. Here's a clue. Crypto doesn't replace the yen in crisis. When blood hits the street, guess what? People still run to the Japanese yen, not your digital moonshot with a dog logo. So what's the lesson here? The yen isn't a toy. It's not a trend. It's a complex beast fueled by fear, monetary policy, carry trades, and massive capital flows. If you don't respect it, it will slap you, hard. And when it does, don't come crying to your Discord group. They're just as clueless. Listen, if you actually want to grow, to elevate beyond the level of a strategy-leeching fool copying trades off TikTok, then start by studying this. The fundamental role of the Japanese yen in global macro. Understand the Bank of Japan like your life depends on it. Analyze the bond market, watch commodities, study risk sentiment. That's how you get an edge. Not some recycled double top pattern you saw in a YouTube short with royalty-free EDM blasting behind it. And yeah, before your sensitive little feelings bubble up, yes, this language is harsh. It's supposed to be. Because the market doesn't whisper sweet nothings when it takes your money. It screams. And if you're not prepared to scream back with knowledge, then you'll always be food. This is TRAXING, not your therapist's office. The rudeness, it's your alarm clock. But don't subscribe. Seriously, don't. Stay soft, stay ignorant, stay broke. The fewer of you who actually understand this stuff, the easier it is for those of us who do to keep feasting. That's right. You being dumb is profitable for us. So don't you dare hit that subscribe button. Don't you dare come back for more truth. Go back to your fantasy world where the RSI matters more than central banks. Or imagine this. You do learn. You do evolve. You start seeing the chessboard instead of just the pieces. You start winning. You stop being the joke and start writing the punchlines. Wouldn't that be wild? But hey, what do I know? I'm just a voice on a black screen saying what nobody else has the guts to.